credit a guy named Don Durrett, who I love his MO. He says, look, silver's going to 150. What is this going to be worth at 150? And of course, the number is always like 10 times higher than where it is. And I believe that. I mean, I believe it will be 150. I wouldn't even rule out it's going to be way beyond 150 because of all the things that are going on. Imagine if India actually starts buying this stuff. It'll be crazy. There's going to be a shortage impact here. And the stocks have massively underperformed the price of gold and silver. There's a lot of catching up to do. I bet you there's 100% catch up to do without the price of silver or gold even going up. When these guys start reporting what they can earn at $80 silver and $5,000 gold for a quarter, I think the stocks are going to react very powerfully. Imagine if silver did go to 300. I mean, wouldn't you love to have a silver resource? And I know I own a couple of those little guys that had 30 and 40 million ounces, and everyone would say, well, it's too small. Well, you know what? 40 million ounces at $100, that's $4 billion worth of silver. Yeah. Gold's not valuable for the economy. Silver is vital. And of course, now they've made it a critical metal in the States. So
I want to just start with the market mechanics first, because, the CME experienced a Globex technical interruption this week as a second one now, affecting metals and natural gas. There's about 90-minute halt, which the CME attributed to technical issues. Now, last year, you predicted that the physical demand would eventually drain the paper exchanges. I mean, with the current inventory trends and premiums we're seeing, combined with this week's trading interruption, does the data indicate we're witnessing a physical short squeeze playing out, or what do you make of this?
Well, there's no doubt there's a physical short squeeze going on. Yeah. We can track the inventories at the LBMA. We track them on the CME. We can track them on the Shanghai Gold Exchange. So, for example, Shanghai today, they lost 10% of their inventories today. They're down to about 11 million ounces. I mean, that's almost zero for a country the size of China. So everywhere you look, you see issues. And to the point you're making about the CME and their technical issues, those kind of are suggesting to some of us who watch this that there's some shenanigans going on that are trying to get the banks off their short positions, because there's still a short position of, I think, roughly 500 million ounces of silver on COMEX. And I don't see the miners doing that. It's mostly banks. In fact, there was a delivery report today for the March contract, and the second largest person issuing the silver, physical silver, was the Bank of Nova Scotia. And they delivered about 5 million ounces.
A 90-minute technical issue rarely shows up when inventories are flush and markets are calm. As Eric Sprott points out here, Shanghai inventories dropping 10% in a single session to roughly 11 million ounces is not noise, it's strain. When you layer that against an estimated 500 million ounce short position on COMEX, the question isn't volatility, it's structural risk. Investors should notice that miners aren't the primary shorts, banks are, and that shifts counterparty risk squarely into the financial system. Next, Eric Sprott discusses whether this squeeze is accidental or engineered.
Those must have been 5 million ounces they were short. And I got to thinking, if you're short 5 million ounces and it was coming up on February 26th, isn't it wonderful that the silver price went from 120 down to 80? Mm-hmm. Think of the saving on 5 million ounces. I mean, you're talking a couple $100 million here. So that's serious stuff. And it's kind of surprising. Our banks have been pretty significant in these deliveries, by the way, whether it's BMO or Scotia, sometimes RBC, not as much as the others, but they're in the game. And of course, it's all these banks that thought they could control gold and silver, that they've lost control of gold. And I'm pretty certain they've lost control of silver here. And we also have some developments that are just mind-boggling today that I think will dramatically change silver and gold. And it's when the Indian government came out and said, we're going to mandate that mutual funds and ETFs in India can now own up to 35% of their assets in gold and silver. And this pool of assets is $385 billion. Well, that's a large percentage of that's a little over $100 billion. And of course, the biggest owners of gold and silver in the world are the Indians. And then they made one other important comment. We are not going to price off of the LBMA or the COMEX. We don't want to, we're going to use prices established in India.
When a $40 price swing saves a short seller hundreds of millions, that's not just volatility, that's incentive. As Eric Sprott points out here, a drop from 120 to 80 on 5 million ounces implies roughly $200 million in relief, and that should make investors question timing around February 26 deliveries. Meanwhile, India potentially reallocating up to 35% of a $385 billion asset pool into gold and silver is a structural demand shift, not a headline pop. If pricing migrates away from LBMA and COMEX, Western benchmarks lose influence. Next, Eric Sprott unravels what that power shift means for global price discovery.
And of course, who's the biggest winner in the world with the price of gold and silver going up is India. Because they own about 40% of all the world's gold in my mind. So they, for a long, long time, encouraged people to own gold and silver. And they do own lots of gold and silver. So you can imagine, by the way, the new regulation starts on April 1st. So we're not going to see the impact yet, although certainly people like myself and your listeners will be vitally interested in knowing that as of April 1st, they can buy those products. So we'll see what happens.
Yeah, it's been fascinating to watch. And I mean, even the SEBI, they're trying to price it at spot prices for the first time ever locally, which, again, almost some backwardation. It feels like the East has taken over the West price action here.
Oh, they're the big owners. I mean, the Chinese, the Indians, they're the big owners. And you know that I don't think there's any developed country central bank buying gold, but there's lots of lesser known countries, central banks buying gold, a lot of them. Mm-hmm. So you can see that divergence all over the place. And of course, the Indian central bank is buying. The Chinese central bank was a big buyer. There's just a bifurcation here of interest.
April 1st may matter more to metals markets than the next Fed meeting. As Eric Sprott points out here, India's long-standing cultural accumulation combined with regulatory change creates incremental demand layered onto central bank buying from China and other emerging economies. If developed nations aren't major buyers while emerging markets are, that's a geopolitical capital flow shift, not just a commodity cycle. Spot pricing reforms through SEBI hint at localized price discovery and possible backwardation pressures. For long-term investors, this suggests ownership migration eastward. Next, Eric Sprott talks about how that bifurcation reshapes control of the gold and silver trade.
But, if you're the guy who's short the 500 million ounces, i.e. the developed country banks, you don't want to see silver going up. You don't want to see gold going up. So there's been that negative bias, but as I say, I think we are now overcoming that bias due to the rest of the world sort of coalescing around gold and silver.
Let's talk about the price action. I mean, silver is mined at roughly 8-to-1 ratio to gold. If the market forces a reversion to the historical 15-to-1 ratio with gold in the low 5,000s, I mean, that puts silver well over 300. I mean, what do you think here? The current physical inventory trends, does that accelerate this timeline?
Well, I've always thought that we should go back to 15-to-1. Yeah. And our way in going to 15-to-1 will overshoot. So we might go to 10-to-1. And as you pointed out, the mining ratio is 8-to-1. The utilization of silver versus gold, maybe 10% of gold is utilized somewhere and 90% is just stuck in a vault. Whereas in the case of silver, I'm sure that 100% of all the mined output is used every year in whether solar panels or solid state batteries or you name it, healthcare, whatever, it's used. So it's a more useful commodity. Therefore, it might, in some sense, be more valuable than gold.
A 500 million ounce short position colliding with a tightening physical market is not a comfortable math problem. As Eric Sprott points out here, if gold trades in the low $5,000 and the ratio compresses toward 15-to-1 or even 10-to-1, silver's upside becomes nonlinear. The mining ratio, near 8-to-1, and near total industrial utilization contrast sharply with gold's vault-heavy demand profile. Investors should ask whether price suppression can persist when industrial demand and monetary demand align. That asymmetry is where volatility turns into repricing. Next, Eric Sprott discusses how fast that ratio shift could unfold.
Gold's not valuable for the economy. Silver is vital. And of course, now they've made it a critical metal in the States. So I think the outlook and expectation is that silver will trade at 15 to 1.
I mean, you've highlighted Samsung's solid-state battery requiring up to 1 kilogram of silver per unit. I mean, are we reaching a point where major automakers and technology companies will be forced to bypass the exchanges entirely, buy, silver miners outright to secure their supply chains? I mean, what does this look like?
Yeah, I think it's going to happen. I think it might be happening already, Jeremy, in the sense that Samsung did a deal with Silver Storm Energy that they're going to buy all their silver output, okay, and then advance them like $5 million to get started. The other indication is for somehow Hecla and First Majestic both sold their silver well above the average spot price in the quarter last quarter. I don't know how they did it yet, but it could be that some silver user just said, look, we'll pay you $10 extra as long as you commit to sell it to us. So I don't know the answer to that. Matter of fact, a sharp reporter like you will figure it out, okay, and tell me too what the answer is.
When industrial buyers start prepaying miners, that's not speculation. That's supply anxiety. As Eric Sprott points out here, Samsung locking in output and advancing capital signals that downstream users don't fully trust exchange liquidity. If companies are willing to pay $10 above spot just to secure volume, that's a quiet premium the futures market doesn't reflect. For investors, this hints at a two-tier pricing system forming between paper and physical markets, especially as silver gains critical metal status. The question isn't if bypassing exchanges happens, it's how widespread it becomes. Next, Eric Sprott discusses how that shift pressures listed producers.
I'm looking for it, Eric. I'll talk to Keith over at PDAC for sure.
There you go.
Hey, I mean, we got to talk your book. I mean, I only got you for a half hour, so I'm going to move fast. I mean, if you look at your capital deployment, specifically your single largest investment right now, Hycroft Mining. I mean, you first invested in 2022 alongside AMC. Late last year, you absorbed the majority of their stake, and the SEC's filing showing you adding another 6.3 million. What, you own over 40% of that deal? I mean, here's the question. I mean, it's in Nevada. It holds over 20 million ounces of gold, roughly 700 million ounces of silver. I mean, when silver hits these elevated price levels, the cutoff grades drop. But how are you valuing this asset in the ground today compared to the discount the broader equities market's currently applying?
I would look at it this way. Well, first of all, their reserve calculation went from 1.6 billion silver equivalent ounces, just announced about 10 days ago, to 2.6 billion ounces. And it didn't even include some of the high-grade drilling that they'd done in 2025, serious high-grade silver drilling.
Owning 40% of a miner is a conviction bet, not a trade. As Eric Sprott points out here, expanding reserves from 1.6 to 2.6 billion silver equivalent ounces in days fundamentally alters asset valuation math. Yet equity markets often discount in-ground resources until cash flow is visible, especially in Nevada projects tied to 2022 capital cycles. If higher silver prices lower cutoff grades, reserve economics can shift quickly, but that requires sustained pricing, not spikes. Investors should weigh balance sheet durability against resource upside. Next, Eric Sprott unravels how he prices optionality before Wall Street does.
So I look at 26 billion or 2.6 billion equivalent ounces, and I believe that's more than Hecla has. I believe it's more than First Majestic has. I think there's only one silver producer. It's a Mexican company that has more than they do, and it's Fresnillo. And of course, Fresnillo hardly ever trades. I think there's a very small percentage of their stock that trades. So I think Hycroft has more product in the ground than anybody else, okay? And you know what? We're not selling it at cheap prices. We'll be selling it at 150 and 200 when we get there. So this is a very valuable commodity. The market hasn't yet learned to pay for gold and silver in the ground. Sure. I think they're coming around here. You know, you can tell by the trade that's going on that anytime somebody comes out with a resource now, and it's a good resource, the market understands it and reacts to it, which it didn't do till about 6 months ago. But you definitely see it now. In fact, one of the other things that we're seeing is we are seeing the small cap mining companies that, and I'm using the TSX TSX exchange, that gold is starting to outperform the other ETFs like GDX and GDXJ.
Resource size means little if the market refuses to assign value to it. As Eric Sprott points out here, comparing 2.6 billion equivalent ounces to peers like Hecla or First Majestic Reframe Scale, but investors must separate geology from execution risk. The shift in TSX Venture names outperforming GDX and GDXJ suggests early stage capital rotation, often seen before broader institutional participation. Still, pricing projects at $150 to $200 silver assumes margin stability and political continuity. Optionality is powerful, but it's also volatile. Next, Eric Sprott talks about why juniors may lead before majors catch up.
Just the smaller little companies, the penny horribles. And I can see why people would do that. Each of those guys has some amount of product in the ground. And, there's prices where everyone's product in the ground will be profitable. Imagine if silver did go to 300. I mean, wouldn't you love to have a silver resource? And I know I own a couple of those little guys that had 30 and 40 million ounces, and everyone would say, well, it's too small. Well, you know what? 40 million ounces at $100, that's $4 billion worth of silver. Yeah. But hey, not that small. No, you can do well by that. So we see that happening. I'll tell you one other thing, Jeremy, that would be very interesting. And you would have gone through this. We are going to get into, and I don't know if I mentioned it to you the last time, but we're going to get into what I call the Nortel effect. And the Nortel effect is when the world decides they want to own something, as they did when they all wanted to own Nortel. So all these funds from around the world would buy Nortel.
Small caps become strategic when price assumptions change. As Eric Sprott points out here, 40 million ounces at $100 silver implies $4 billion in gross metal value, a scale the market often ignores at lower prices. But valuation expansion depends on capital flows, not just commodity math. The Nortel effect he references is really about crowding risk. When global funds chase limited float, liquidity squeezes and volatility spikes. For retail investors, that cuts both ways. Explosive upside and brutal drawdowns. Next, Eric Sprott discusses how foreign capital could distort junior mining valuations.
The weighting in the TSX would just keep skyrocketing, and none of the Canadian institutions could then thereby have enough because foreigners are buying it. Well, that's what's going to happen in the gold stocks. As everybody wants to buy gold stocks, and they're predominantly listed here, or the Canadian domiciled, there's going to be a shortage impact here. And the stocks have massively underperformed the price of gold and silver. There's a lot of catching up to do. I bet you there's 100% catch up to do without the price of silver or gold even going up. When these guys start reporting what they can earn at $80 silver and $5,000 gold for a quarter, I think the stocks are going to react very powerfully.
Yeah, well, you're putting your money where your mouth is. I mean, you're aggressively sweeping the broader junior sector. You just anchored a $3 million placement for Rio Silver. You deployed another $10 million into Silverco, put 40 into Highlander Silver in Peru. I mean, what is the specific geological metric now that gets your signature on the term sheet? I mean, what's the secret sauce, Eric?
Here's the quiet imbalance no one's modeling. Foreign capital can overwhelm a thin domestic market fast. As Eric Sprott points out here, Canadian listed gold equities have badly lagged bullion, creating what he sees as 100% upside just on multiple expansion. If miners start reporting cash flow at hypothetical $80 silver and $5,000 gold, quarterly earnings could re-rate price to cash flow ratios overnight, especially in juniors with tight floats. But investors should ask, Are those price decks realistic before the next Fed pivot or recession scare resets demand assumptions? Next, Eric Sprott unravels the geological filter behind his aggressive capital deployment.
Well, I think what you have to do, and I'm going to credit a guy named Don Durrett, who I love his MO. He says, look, silver's going to 150. What is this going to be worth at 150? And of course, the number is always like 10 times higher than where it is. And I believe that. I mean, I believe it will be 150. I wouldn't even rule out it's going to be way beyond 150 because of all the things that are going on. Imagine if India actually starts buying this stuff. It'll be crazy. So, you put 150 on some guy producing a million ounces, all of a sudden he's making $150 million of profit. And you put a multiple on that now. Well, you have to tax it, of course. But anyway, the upside is it's magnificent.
Wow.
There's many, many companies that could go up 10, 15, 20, 40 times with the endowment that they have with price increases.
Pierre Lassade, I think it was Juicer, everyone was leading this kind of, wanting to get pension funds into Canada, the institutions finally buying, as you kind of mentioned there briefly.
Projecting $150 silver makes every spreadsheet look brilliant, but assumptions are doing the heavy lifting. As Eric Sprott points out here, valuing a 1 million ounce producer at $150 silver implies $150 million in profit before tax, and that's where 10x narratives are born. What's not said loudly is that commodity multiples compress when prices spike, governments adjust royalties, and costs inflate alongside metal prices. India demand, pension inflows, and momentum capital are possibilities, not guarantees tied to any Fed decision or 2024 to 2025 growth path. Next, Eric Sprott discusses whether institutional money is actually moving or still watching from the sidelines.
You seen any proof of that happening yet? That hasn't even started.
No, I have not seen it. I wish I could say that. I mean, I actually do ask the question very often when I'm involved in underwriting. Are there any non-gold funds that are participating?
Yeah.
And so far, it's been pretty de minimis. I don't think that it's hit yet. And of course, I always sort of jokingly say, well, maybe the pension fund managers won't figure it out, but the computers will. When they say, oh, the best performing group this month, oh, that was gold. Yeah. Best performing group the next month, gold. Next month. Best group for the year, gold. Well, when are you going to put it together? The world's buying gold. The world is buying gold. How you wouldn't know that? You're not reading things if you don't know that the world's buying gold. Yeah. So why would you not buy gold? So, in fact, I heard that, not that I really like Jane Street being in SLV, but they've got might own 10% of SLV.
Huge position.
Momentum hasn't arrived yet, and that may be the real tell. As Eric Sprott points out here, traditional non-gold funds are barely participating in underwritings, meaning this move is still specialist-driven rather than pension-fueled. He's betting that performance-chasing algorithms will rotate capital once gold tops sector rankings for consecutive months, a pattern we've seen in prior cycles. But retail investors should remember, late institutional inflows often mark mid to late innings, not the beginning. Positioning data like large stakes in SLV hints at growing interest, yet broad allocation shifts remain absent. Next, Eric Sprott shows what happens when billion-dollar flows hit illiquid juniors.
Yeah, and you can see when the gold stocks started rallying at about 11 o'clock yesterday morning, when gold and silver were still down, but the gold stocks started rallying. Some people are just people are coming into this market for sure in big size. In fact, I heard about a manager in England who ran $1 billion fund. He just received another $1 billion. And I think, okay, bring it on. Like $1 billion. You try to put $1 billion into some of these stocks, particularly the junior or intermediate size guys. I mean, there's going to be some serious run up going on here.
Yeah, that's a lot of movement, especially, it feels like this cycle, people were not as frivolous with share structures too. People learned from the last time around.
Yeah, I only wish the dealers would learn that you don't have to sell everything at a 10% discount.
Yeah.
Man up here, okay, boys? People want to own these things. You don't have to underprice everything. It really bugs me when companies and bankers, they'll raise 100 million, but the market cap goes down 100 million when they cut the price. It really frustrates an existing shareholder. You know, you're not doing us any favors by that kind of pricing on both fronts, management and the underwriters.
When stocks rally while the metal is down, someone bigger is positioning early. As Eric Sprott points out here, gold equities bid higher intraday, even with bullion red, suggests institutional-sized orders stepping in ahead of the headline move. $1 billion trying to enter thin junior names can distort prices fast, but it also exposes how underwriters habitually price deals 10% below market, erasing shareholder value overnight. That dilution game benefits bankers more than long-term owners. Liquidity squeezes can be powerful, yet structured discipline